Hi guys, my name is Jean Nicole and this is Strays by Jean Nicole. Thank you for joining me today. I wanted to talk about why you may be losing. And the number one reason you may be losing is not about discipline or strategy or patience. It's really about you fighting the market. Have you ever had that situation of the price is shooting up and you're afraid of joining, so you short the market because you think it's went up too high, too fast? Well, this is for you. Let me start by saying this first because someone needs to hear it. If you're struggling in trading right now, if you feel like no matter what you do, the market is always one step ahead of you, if you feel like prices almost like mocking you, you ever had that where you're 1 point from take profit and the market reverses on you? Yeah, me too. This video is for you. You are not broken. You're not stupid. And you're not bad at trading, honestly. What's really happening is you're fighting the market. And the market always wins when you fight it. Most retail traders don't lose because they don't work hard enough. They lose because they're unknowingly going against forces that are much bigger than them. Today, I want to show you why that happens and most importantly, how to stop doing it. This question gets asked all the time. Why do most traders lose? I want you to really hear this part. It's not because they're bad traders. It's not because they lack discipline. It's not because they didn't buy the right indicator. Most traders lose because they don't understand who they're trading against. You hear all the time that the market is a random events, a series of random events. That is not true. The market is not random, and it surely is not fair. It's definitely not designed around retail traders winning easily. And a good example of that is if you've heard recently about the CME raising margins again, trying to push out retail traders. So if you go check the latest data, you will see that the CME has raised the margin requirements for us to trade metals such as gold and silver. So again, this market was not meant for us retail traders to win easily. The market is a hierarchy of players, and retail traders sit at the bottom of that hierarchy with the least amount of power. Once you understand that, everything starts to make sense. This slide is the key to everything. The market is structured like a pyramid. At the top, you have tier one banks and institutions. Below that, you have middle banks, hedge funds, and large asset managers. Then you have brokers, execution desks, and market makers. And at the very bottom, you have us, retail traders. And I want you to notice something important here. This hierarchy is not about intelligence, it's about capital, assets, and control of liquidity. The higher you go up the pyramid, the more influence a participant has over price. Retail traders don't move markets. Retail traders react to markets. That distinction matters. At the very top, we have tier one banks, institutions, and liquidity providers. These participants are not trading 5-minute charts. I tell my mentees this all the time. They're not chasing breakouts, they're not reacting emotionally. They operate on the daily, weekly, and monthly time frames. Do you think a hedge fund manager is on the 1-minute chart? No, they're not. Not even the 15-minute chart. Their job is to manage massive order flow, control inventory, and seek liquidity at scale. They're not trying to be right on every candle. They're trying to execute business objectives. And that means price often moves in ways that confuse retail traders because those moves aren't about you. They're about liquidity. In the middle of the hierarchy, we have hedge funds, asset managers, and execution desks. These participants trade more on macro themes, rebalancing, and risk exposure. They facilitate large orders, they manage portfolios, they reposition based on flows, not emotions. This is where a lot of directional pressure in the market comes from. And here's the part most retail traders miss. These players need liquidity to enter and exit positions. They don't chase price, They let price come to them. Now let's talk about us. Retail traders usually trade smaller positions, shorter time frames, and we're often very focused on news, patterns, and immediate price action. And because of that, we tend to miss the bigger auction that's taking place. We see a breakout and think that's it. We see price pull back and think I'm early. But most of the time, we're reacting to moves that were designed to create liquidity, not trends. That's not a character flaw. That's a knowledge gap. Don't take it personal. This slide right here describes so many trading journals. Retail traders tend to fade strength, short highs, buy lows too early. And why does that happen? Because retail is often trading unfinished business. They're trading inside ranges that institutions haven't completed yet. They're stepping in before liquidity has been properly taken. So price moves just far enough to pull you in, then reverses and stops you out and continues without you. I know we've all had that happen. That's not bad luck. That's structure. This is where this is where things start to shift. Time is a filter. Higher time frames smooth out noise. They show you where price actually makes sense over time. When you align with the daily and weekly structure, you stop reacting to every little move, start seeing intent instead of chaos. The market doesn't move randomly, it moves in phases. And higher time frames tell you which phase you're in. Smart money doesn't always move price to make profit immediately. Sometimes price moves to accumulate, sometimes it moves to distribute. And that's where most retail traders get confused. Accumulation looks boring, distribution looks deceptive. But once you understand that not every move is meant to trend, you stop fighting the market and start alignment. This is the turning point. Stop chasing struggle. Stop trying to outsmart price. Stop taking trades out of frustration. Instead, follow their footprints, trade with intention, focus on liquidity, no emotions. Focus on liquidity, not emotions. You don't need to predict the market. You need to align with it. When you stop fighting the market, trading gets quieter, cleaner, and more controlled. I want to leave you with this. Power in trading doesn't come from being aggressive. It comes from understanding. When you understand market structure, when you understand who's really moving price, you stop blaming yourself for things that were never personal. Equip yourself with market knowledge. Stay on the market side of the trade. And if this helped you see the market differently, follow Trades by Gina Cole for more. You don't need more trades, you need better context.